welcome back for our continued reporting on COVID-19 market updates. Today, we have our very own Russ Putterman with the Focus team. We also have a special guest today, Todd Zipkin with Americana Mortgage, and Todd is one of the owners of Americana Mortgage. Today, we'd like to get a little more information around what's going on for lending in the tri-state area.
Great. Thank you, Courtney. Nice to be back here again. And thank you, Todd, for joining us today.
No problem. Thanks for having me.
No worries. Todd and I have known each other a long time, and always keep each other apprised, I think, on what's going on in the markets out there. One of us, obviously myself from the real estate perspective and Todd from the mortgage side. So what are you seeing out there?
Well, obviously right now we're in a crazy time. We have the mortgage world, which, the good thing is that loans are still happening. Banks are still lending. So we have no issue with that, but guidelines have changed. There are some more strict guidelines going on in the business right now. You're basically going to have things like where it's become more difficult is sometimes for a self-employed borrower, because a lot of times with self-employed, it's all based on income from the past. And banks don't know with self-employed people what the income is going to be this year. So they're trying to just be a little bit more strict on their end with regards to they're going to want to see that businesses are operational within 10 days of closing. They're going to want to see proof from either an accountant or some form of invoice or some form of payment receipt, just to kind of prove that a self-employed person is still operational. From other standpoints, you have rental income. Banks are a little concerned right now that some tenants are not paying their rents. So they want to know that when somebody is refinancing or purchasing an investment property or anything that has rental income on it, they want to see that that client is going to have reserves. So in case they can't be paid for a few months, they have the ability to keep their mortgage current.
Got it. Okay. So you touched on a few different things. Okay. So I get it with the self-employed people, and I'm sure there's a lot of, business owners and entrepreneurs out there. What about for, your W-2 employee who's sort of been, on a sort of an even keel for a number of years? Like, what does that look like?
Really no change. There's no issue. They're still using 100% of their income. They're going to, again, do a verification of employment to make sure that the borrower is still employed within about 2 days of when they close, which really isn't that different from what it's always been. They always do a verification of employment towards the beginning of a loan, then they always try and verify that the person is still employed. So right now, some of those verifications are a little bit more difficult to get, but as long as these banks can verify through a senior party at the company that the borrower is still employed, then everything is pretty much the same as it was. As long as they're not furloughed and they're still getting paid, then everything is pretty much the same.
Okay, so fine. So that's good, difference between a W-2 wage employee and somebody who's self-employed. So now let's talk about loan size. I hear this chatter about if it's a jumbo loan, it's a little more difficult to get as opposed to it being a conforming loan. And then I've also, seen over the years, there's actually more than one jumbo threshold. One is 5 and change, the other one's 760 something and change. Can you talk just briefly a little bit about that, and then what you're seeing as far as availability and rates as the numbers change?
Yes. So the first thing is there are 3 different levels. You have your conforming loan size, you have your high balance loan size, and then you have your jumbo. Your high balance is going to be anything that's going to go up to about $501,000 right now. That's where you're going to have the regular conforming, strong rates. Once you go above that number and you go all the way up to about $726,000, I believe the number is, then you're going to have what's called high balance, where the rates are a tiny bit higher. The guidelines are basically the same as what they are for conforming. What you're talking about, where you really start to see some of these differences are going to be in the jumbo market. A lot of these jumbo lenders they already have a more strict debt to income ratio. They're only going to let you use about 43% of your income, where for other loans for conventional, you can go up to about 49 to almost 50%. I have seen that some of the jumbo lenders are starting to reduce the loan to values down depending on the loan size, because even in jumbo, which is above that $726,000 mark, you still have other loan sizes and other thresholds that can change things. If you start to go above with some lenders the $1.5 million or the $2 million loan mark, then some of those guidelines can change, where those loan to values come down a little bit.
Got it. I think this is really interesting because, a lot of this speaks to the markets that we sell in. We're selling in Manhattan, obviously. So some of the loan sizes are, 2, 3, 4, 5 million plus. And we're selling out in Long Island and New Jersey, where, yes, the home values may be north of $1 million. However, a lot of them aren't, right? So, you're kind of delving into all these different angles. So let's just for a quick second talk about the New York City loan that somebody's looking to get, for a luxury property. So if somebody wants to buy a $7-8 million apartment and they're looking to take debt in today's market, what can they expect?
They can expect lower loan to values than they were going to look at and going to get a few months ago. I know that personally I've looked into things where, you were generally going to be in that 75% area for those ultra luxury, ultra jumbos, where a lot of times you could get an exception and get to an 80%. Right now, from the contacts that I've been speaking with, those numbers have been lowered, where most of these lenders are going to kind of try and keep it at that 65 to 70% loan to value, where then they'll give an exception to try and bump that to 70 or 75%. But again, that's for the, ultra high loan sizes. Anything that's going to be under, I'd say, $1.5 million, $2 million, that's probably going to stay where it was, at that same 80% LTV range.
Got it. Are you seeing rate differences between refis and new purchases?
I am. For regular conforming loan sizes, you're not going to see that much of a difference. Once you get to jumbo, from what I've seen, a lot of the jumbo lenders are between 1/4 and 1/2 point higher on refinances than they are on purchases, depending on the bank, depending on the scenario. So purchase rates are a little bit more aggressive than refinance rates when it comes to jumbos. But again, for the regular conforming market, it really shouldn't change that much based on purchase or refi.
Okay. You and I were in conversation when at the outset of this around rates, and rates had dropped pretty significantly right away, and then there was a run on getting refis done, and a lot of banks actually then started to increase their standards, and were lending a little bit less, and that seems to have eased a bit. Am I right in saying that?
It has eased to a point. I mean, I think the banks are getting a little bit more normal with what's going on now. They kind of have a good understanding of what's going on, but it's still we're not out of the woods yet. As far as interest rates, the rates did plummet to an all-time low when we were first kind of getting into this, and then, like you mentioned, there was such a run on the banks for refinances that, from the numbers that I read, the banks took on between 11 and 12 trillion dollars in 3 weeks in refinances, which is almost 3 to 4 times the amount that America does in a year for purchases and refis. So that really kind of handcuffed these banks to not want to take any more loans. And because of everything else that was going on in the world and the market, you had investors that were basically fleeing the market. So you had no banks that wanted to lend, and you had no investors that wanted to buy, which caused the rates to just fly up. Then the Fed stepped in. They kind of put some liquidity back into the market, which brought the rates back down. So it has, I would say, loosened up a little bit, but we're not out of the woods yet.
Okay, fair enough. So last question, and to that end, so what do you see for the lending market over the next 8, 12 months?
I think that we're gonna see a lot of what we're seeing now with regards to verifications of employment, with regards to the banks wanting to see reserves on investment properties, or more reserves than they used to want to see. They're going to want to see reserves on self-employed people, again, because they don't know what self-employed income is going to look like until tax returns are filed. So, I think we're going to be in this for a while. Loans are definitely getting done, so there's no issue closing loans. It's just a little bit more strict. And we all went through this in 2008. 2008, when the whole market blew up, there were companies that left the market. There were programs that were more aggressive that left the market. And eventually those programs came back. And the same programs that left the market a month or so ago, they're going to come back again. It's just going to depend on when and how long this lasts. So I think for the foreseeable future, we're probably in the same general market we're in now. But eventually, I think things will go back to the way they were once we're out of this.
Got it. The one thing I'll tell you that I see that's very different from 2008, 2009 is that at that time, I recall there being a lot less liquidity. So the deals that were getting done were really cash deals, especially in Manhattan. And that's what really caused, at least in Manhattan, the market to quote unquote dip a bit, is because if you didn't have cash, you weren't getting the deal done. And if you really need to sell, you were taking a cash buyer at a discount.
Right.
The rest of the country, or the majority of the rest of the country, was dealing with the subprime issue, which really didn't affect Manhattan all that much.
Right.
This time around, it's just seems very different. The economy was in a good place. This was caused by something else, and and aside from Manhattan and around this area anyway, in the tri-state and the places that we sell, I mean, it's very busy. I mean, there's a lot happening. I mean, New York is hamstrung outside of Manhattan by the fact that they can't actually show, but here in New Jersey, things are busy.
I agree, and I also think that once this loosens up a little bit, especially in New York, and people can kind of get back outside, and social distancing won't stop, but at least it'll kind of relax a little bit. I think that the market's going to be fine. I mean, I think there are going to be a lot of real estate. A lot of people that own homes that just want to get their homes on the market because they were thinking about doing it before. Maybe some people potentially want to leave the New York market and sell their homes. And then you're going to have a lot of buyers that, again, were just ready to buy. And then some people that might want to move out of certain places like the city and want to move to things like Long Island. So I think the market's going to be fine.
So there's been some talk about, the ability to defer your mortgage or forbear your mortgage. And I know a lot of people out there are looking to refinance their mortgage. What can you tell us sort of about that whole world?
So I know that every bank is different. Every lender is going to be different with what they're going to allow as far as letting people, not pay their mortgage right now. But with regards to refinancing, every lender that I've spoken with, every single one has mentioned you cannot be in forbearance, that your loan must be up to date at the time that you want to refinance. So that's something that you have to make sure of. If you're planning to refinance, you're not going to want to go into some type of forbearance program with your current lender. With regards to that as well, you're also going to want to try and get your documents in as quickly as possible, because in this market with jobs, and you just never know what's going to happen, you just want to get these things closed and not let these things fester. One last thing I would say about refinances, there's something called a SEMA, or an assignment of mortgage tax, that a lot of people hear about. That goes towards potentially saving money on your closing costs in a refinance. When you do an assignment, you are assigning the mortgage tax that you previously paid when you last purchased or refinanced your home. I have been recommending to my clients, at least that live on Long Island, that they should not do assignments of mortgage tax, because although they will save money on their closing costs, it can delay the process by 6 to 8 weeks. And then any rate lock that you wanted to do right now, you might not be able to actually go forward with. And then you might end up missing the rate that you wanted. So that's just one thing I've been recommending. If you're in the city, in the boroughs, it's 1.8%. It makes more sense to take the chance, do the assignment, because you're saving much more. On Long Island, it's only 0.8%, and you're generally not going to save enough money where it's going to make sense.
All right. Well, thank you for taking some time to chat with us. I
No
appreciate
problem.
it.
Thank you for having me.
No worries. And if there are other topics or other questions that you have for Todd, you can let us know at info@focusreg.com. And you can hit us up on our social channels at FocusReg. Thanks for being here.
No problem. Hang in there.
You too, bud.
Thanks. See you soon.